Welcome to a deep dive. Today we're really getting into something that hits anyone trying to launch something new, that feeling of extreme uncertainty.
Right. And we've got a great set of sources here, all pointing towards a powerful way to handle that uncertainty. It's all based around Eric Ries's work, the lean startup method.
Yeah, and this isn't just some niche idea. The praise is pretty significant. Things like a roadmap for innovation for the 21st century.
Or one of the best and most insightful new books on entrepreneurship and management. It's aimed squarely at those moments where you honestly don't know if your big idea will fly, if customers will even care.
So our mission today is to pull out the really essential stuff from these sources. What do you actually need to grasp about this whole method to, well, up your chances of creating something innovative that lasts, especially when things feel really foggy?
Because that romantic picture, the lone genius founder, the sources make it clear that's often not how it goes down.
Yeah.
Failure rates are incredibly high.
Yeah, it highlights this desperate need for a more rigorous approach, almost scientific, really.
It suggests it's less about having that perfect idea right at the start and more about having a solid method to find the right idea.
Okay, let's dig in. Starting with the basics. What exactly is a startup in this lean startup world? And what's the fundamental problem it's trying to solve?
Well, the definition itself is interesting and maybe broader than you'd think. The forces define a startup as a human institution designed to create new products and services under conditions of extreme uncertainty.
Human institution, extreme uncertainty. That feels different. Not just, a brand new company.
Exactly, and that has a huge implication.
Yeah.
Entrepreneurs are everywhere. It's not just the classic garage startup scenario.
So if you're in a big corporation trying to launch a new product line, or maybe a nonprofit with a new service.
Or even innovating inside government. If you're dealing with that high level of uncertainty about whether something will work, these ideas apply. You're essentially acting as an entrepreneur in that context.
So the core issue isn't always like a lack of smarts or hard work. The sources say innovators often struggle because of that uncertainty. New stuff often means, well, messing up along the way. Failure on the way to greatness, as they put it.
Precisely. And trying to apply standard management practices, the ones built for stable, predictable environments, it just doesn't fit. It breaks down.
Which leads to this idea that entrepreneurship actually is a form of management.
Right, but a very specific kind. One tailored for navigating that uncertainty, for finding your way when the path isn't clear at all.
Okay, that sets the stage. Now, the foundation. The lean startup rests on 5 core principles according to the sources. We've sort of touched on the first 2 already.
Yeah, entrepreneurs are everywhere, and entrepreneurship is management, but, adapted management.
So where does it start getting really distinct? What's principle 3?
This one's a big shift, maybe the biggest. Validated learning is the unit of progress.
Validated learning. Okay, sounds a bit academic. What does that actually mean? Boots on the ground, trying to build something?
It means you stop measuring progress by just building features or hitting internal deadlines. Instead, your real measure of progress is learning. Specifically, learning whether your core ideas about the business are actually true.
So finding out things like, do people use this? Do they pay? How do they even find out about us? That kind of learning.
Exactly. Shipping a feature isn't progress unless you learn something concrete about your customers from it.
Okay, so it has to be demonstrated, not just assumed.
Yes, validated learning is described as rigorous, empirical. You need evidence from the real world, from actual customer behavior, that tells you valuable truth about your business's chances.
And this replaces, what did the sources call them? Vanity metrics.
Right. Those metrics that, look good on a chart, total signups, page views, but they don't actually tell you if you're building something sustainable.
Like lots of downloads, but nobody sticks around or gets real value.
Precisely. Validated learning cuts through that noise. It forces you to focus on, are we creating real value? Do we have a way to grow that actually works?
And the way you get that validated learning, that's the 4th principle.
That's the engine. Build, measure, learn. The feedback loop.
The core loop. Build, measure, learn.
You take an idea, you build some version of the product to test it out, you measure how real customers respond, and then you learn from that data.
And based on that learning, you decide, do we keep going this way or do we need to make a change, a pivot?
Exactly. And the goal is to spin through that loop as fast as humanly possible, maximize the speed of learning.
Learn faster than the competition.
Yeah.
Makes sense. And the 5th principle.
Innovation accounting, which, sounds maybe a little dry, the boring stuff, the sources call it. But It's absolutely vital.
So what is it? Not regular accounting.
No, it's a specific way of tracking progress for startups. It uses validative learning as the key metric, not traditional profit and loss right away. It helps you set meaningful milestones, learning milestones, and figure out what work to prioritize to maximize that learning.
Okay, so validated learning is kind of the North Star, and innovation accounting is the compass and the map you use to see if you're actually heading towards it through all that fog.
That's a really good way to think about it. It makes the messy process of innovation something you can actually measure and manage in its own way.
All right, let's move into part one. Vision. The sources stress that every new venture, every business plan, it all starts with assumptions.
Yeah, tons of them. And the critical thing is to figure out which ones are the leap of faith assumptions.
Leap of faith, meaning?
Meaning they are the absolute bedrock assumptions. If these turn out to be wrong, the whole thing probably fails. Often they're about how customers will behave or how the market will react.
Like assuming people actually want the thing you're imagining, or assuming they'll somehow stumble across it.
Those are classic examples. And the sources highlight, too, as being super important, generally. The value hypothesis, do customers get enough value to use it or buy it?
Okay, the value hypothesis.
Yep.
And the second.
The growth hypothesis. How are new customers going to discover this product? How will it spread?
They used the early Facebook story here, right? It wasn't just the sheer number of users that impressed early investors.
No, it was the engagement, how much time people were spending, how often they came back. That was powerful validation of the value hypothesis very early on.
And the growth part?
That came from how it just exploded across campuses, mostly by word of mouth, right? They didn't need a big marketing budget initially. That validated the growth hypothesis. Huge leaps of faith, both proving true.
So how do you even begin testing these big assumptions, especially before you've built, the whole thing?
You absolutely have to get out of your office. The sources use this great term from Toyota, Genji Gambutsu.
Genji Gambutsu, meaning?
It basically means go and see for yourself. You cannot understand the customer's reality or the problem you're trying to solve just by sitting in meetings and looking at spreadsheets.
Less PowerPoint, more pavement.
Pretty much. The examples are great. Scott Cook, before Intuit, he didn't just start coding accounting software.
What did he do?
He literally got phone books, called random people, and asked them, hey, is paying your bills by hand a pain? He was directly testing that core value assumption just by talking to strangers.
Wow. That's direct. No MVP needed there, just conversation.
And another one, Yuji Okoya, the chief engineer for the Toyota Sienna minivan. He didn't just rely on market reports.
Right. The source said he traveled across North America.
Yeah, and crucially, he didn't just talk to the parents buying the minivan. He spent time observing and talking to the kids in the back seats. They're the real power users of that space.
Makes sense.
And he learned things about what they needed and wanted that directly influenced the final design.
Yeah.
Things you'd never get from a survey.
So part one is really about facing your ignorance, identifying those make or break assumptions, and then committing to actually going out into the world to see if they hold water.
Exactly. And how you learn that is driven by part two, SPEAR, which is all about using that build, measure, learn feedback loop.
Right. This is the mechanism, the steering wheel, kind of, to navigate through the uncertainty.
Yes. And the build part of that loop starts with the minimum viable product, the MVP.
MVP. Everyone talks about MVPs. But it's not just like a buggy version 1.0, is it? What's the core idea from the sources?
The definition they use is key. It's that version of the product that enables a full turn of the build, measure, learn loop with a minimum amount of effort and the least amount of development time.
Okay, minimum effort, least time, but enough to complete a full turn of the loop, meaning enough to learn something real.
That's the critical part. It's purely about learning. It takes guts, the sources say, to ship something that feels unfinished. And most people tend to overestimate what minimum really means.
When in doubt, simplify. I like that.
Because every feature you add that isn't strictly necessary for learning just slows you down. And it confuses the data, makes it harder to know why customers are behaving the way they are. Fast learning is the goal.
Okay, let's make this concrete. The MVP examples in the sources are really helpful. Zappos is a famous one.
Yeah, amazing. They wanted to test, will people actually buy shoes online? Big unknown back then.
So they didn't build warehouses first.
Nope. They went to local shoe stores, took pictures of shoes, put them on a super basic website. If someone actually ordered a pair, they'd run to the store, buy the shoes, and mail them out.
Wow. So they tested the core assumption demand with almost zero infrastructure risk.
Exactly. And Dropbox, their MVP was even simpler in a way.
Right. They had a complex technical problem file syncing. Hard to build a quick version of that.
So their MVP wasn't software at all. It was a short video. Just a demo showing what the final product would do, how seamless file syncing would work. They put that video out there to see if people even wanted it.
And the response.
Huge. Hundreds of thousands signed up for the beta waiting list just based on the video. It proved the need existed before they poured resources into the really hard engineering.
A video MVP. That really drives home the learning aspect. What about the Groovesmith one? That became food on the table. They used a concierge MVP.
Yeah, that's a fascinating type. They wanted to offer personalized meal plans based on what was on sale at local grocery stores. Super complex algorithmically.
So instead of building the algorithm,
They just did it manually for their first few customers. They acted like a personal concierge, figuring out the sales, creating the meal plan, emailing it week after week.
so they were the product, essentially.
Yes. The manual service was the learning activity. They learned exactly what people valued, what was confusing, what worked, what didn't, all before writing complex code. They learned by doing.
That's clever. And Aardvark, the social search company, they did multiple MVPs.
6 of them, apparently.
Yeah.
Really rapid prototypes, just a few weeks each. They even used humans behind the scenes at first to sort of fake the complex search algorithms.
Testing with small groups.
Yeah. Friends and early users.
Yeah.
Measuring if people came back. 5 of the prototypes just didn't stick. People didn't keep using them. But the 6th one did. That showed them the direction. Rapid iteration. Lots of learning.
And Kodak Gallery used an MVP to test a feature.
Right. An event add idea. They built a really bare bones version, deliberately leaving out features they plan to add later.
And the learning was,
Pretty brutal, actually. Users couldn't even figure out how to make the basic album work. And the feedback wasn't, this is great but needs X. It was, where's feature Y? I can't even do the basic thing.
ouch. But valuable learning saved them building the wrong thing.
Exactly. And Village Laundry Services in India, VLS, they used physical MVPs to test really fundamental stuff.
Like, would people in emerging markets even use a professional laundry service and pay for it?
Yeah. They started with literally a washing machine on a truck, then a mobile kiosk. They learned things they just couldn't have guessed.
Such as?
Customers were suspicious of the truck. They really wanted ironing included. And surprisingly, they'd pay double if the turnaround was faster. Stuff that totally shaped their business model.
These examples really show it. An experiment is the product in this model. The output isn't code, it's validated learning.
Couldn't say it better. And how you measure that learning systematically, that's innovation accounting.
Right. Back to avoiding those vanity metrics. The Grocket example, again tracking total users, felt like progress, but didn't show if product changes actually improved things.
Yeah, vanity metrics are seductive, but dangerous. They don't guide decisions. The antidote is focusing on actionable metrics and using tools like cohort analysis.
Cohort analysis sounds a bit jargony. What's the core idea there? How does it help?
It's simple conceptually. Instead of looking at all your users lumped together, you track them in groups or cohorts based on when they joined. Like everyone who signed up in January is one cohort, February is another, and so on.
Okay, so you group them by sign-up time. Why?
Because then you can see if changes you make to the product today actually affect the behavior of this week's new users differently than last week's new users. Before the change, it isolates the impact of your actions.
I see. So if total users are going up, that could just be marketing. But if the January cohort sticks around longer than the December cohort after you launched a retention feature, that's real feedback.
Exactly. That's actionable. The IMVU example was stark. They were shipping changes daily, but their cohort analysis showed key metrics, like how users moved through their sign-up funnel were flat. Cohort after cohort behaved the same.
Meaning the changes weren't actually improving the core experience.
Right. It pointed to a deeper strategic problem, not just a need for more features. Something fundamental wasn't working.
Split testing, A/B testing is another key measurement tool mentioned.
Yeah, classic way to test specific changes. Grocket used it to test lazy registration, letting people use the site before signing up.
And did that change behavior?
The A/B test showed, nope, didn't really impact long-term usage. So they learned that optimizing that specific flow probably wasn't their biggest lever for growth. Maybe marketing or positioning mattered more.
So measurement is really about designing experiments. Okay, the sources talk about 3 A's for good metrics. Actionable.
Actionable is the first. Does the metric show clear cause and effect? If we change X, does metric Y change in a predictable way?
Makes sense. Second A.
Accessible. The metrics need to be easy for everyone on the team to understand, not just the data scientists. Simple, clear reports. tangible units. The sources even say metrics are people too. Connect them to real customer behavior. IMVU use simple one-pagers.
Okay. Actionable, accessible, and the third.
Auditable. Can you trust the data? Can you actually verify it? I mean, by talking to the customers represented in that cohort or segment? This builds confidence and helps you understand the why behind the numbers. IMVU apparently learned this the hard way. People challenged the data until they could connect it back to real customer stories.
Got it. Actionable, accessible, auditable. And putting this all together, this innovation accounting framework gives you learning milestones.
Yes. Instead of traditional milestones like launch feature X by June, your milestones become validate or invalidate hypothesis Y by running experiment Z. It's about proving assumptions.
And these learning milestones are better predictors of actual success.
That's the argument. They're faster, closer to reality, and give the team much clearer guidance on whether they're actually making progress towards a sustainable business, especially when things are uncertain. It makes progress visible.
Okay. So you build an MVP, you measure using these actionable metrics, you get some validated learning. Which brings us to the crucial decision point in the loop. Pivot or persevere?
This is often the toughest call. You look at the validated learning you've gathered from one or more turns of the loop and ask, are we making enough progress towards our goal, towards proving our core hypotheses?
And if the answer is maybe not, or definitely not,
then it's time to consider a pivot.
But a pivot isn't just like throwing everything out and starting over randomly.
No, not at all. The sources define it very specifically. A structured course correction designed to test a new fundamental hypothesis. It's strategic. It's based on what you learned.
So you keep the learning, but change direction based on that learning. It's not admitting total failure.
Right. It's adapting intelligently. And the danger of not pivoting when the data says you should, that's when you end up in the land of the living dead.
It's a living dead. Sounds grim.
It's where a company isn't really failing outright.
Mm-hmm.
Maybe it has some users, some revenue,
Mm-hmm.
but it's also not achieving its goals, not finding that scalable growth engine. It's just kind of stuck. Burning cash and time without making real headway, failing slowly.
Okay, the Vodafone case study really walks through this pivoting process well.
That's a great example. They started as what? A social network for civic action.
Yeah, and they tracked metrics.
Mm-hmm.
Registration, activation, retention, referral. Very lean startup.
And the initial results.
Yeah.
Registration and activation were okay after some optimization.
But retention and referral were terrible.
Yeah.
People checked it out but didn't stick around or bring friends. The engine wasn't firing.
Right. So based on that learning, especially the low retention, they didn't just tweak features. They made a zoom-in pivot. Yeah. They realized the social network part wasn't working. But their underlying tech for verifying voters and letting them contact officials was potentially valuable. So they zoomed in, focusing just on that piece.
Okay, makes sense. Did that solve it?
It helped. Retention and referral numbers went up significantly.
Mm-hmm.
But almost nobody was paying. Less than 1%. The business model still wasn't working.
So more learning, but still not a viable business.
Yeah.
What next?
Pivot number 2. This time, a platform pivot. Inspired by things like Google AdWords, they thought, what if we let activists pay to use our verified voter tools to reach people?
Build a self-serve platform, leveraging the asset they'd already built, the verification tech, but with a totally different business model and growth hypothesis.
Exactly. Testing a new engine of growth, basically. Transactional, maybe viral elements.
And that pivot.
That one clicked. Metrics improved again, but crucially, about 11% of users started paying per message. That suggested a potentially sustainable economic engine.
Wow. So each pivot built directly on the learning from the previous stage. It wasn't random guessing?
Not at all. They kept the validated learning and the assets they developed. And Wealthfront is another good example of this pivot dynamic.
Right. They started out completely different, didn't they? Like a social network for investing. Stock-picking games.
Something like that. But through talking to people, including people totally outside their target market, like the head of Stanford's endowment fund, randomly enough,
They learned what?
they learned that the underlying tech they'd built to evaluate investment managers was actually incredibly valuable. Just not for amateur stock pickers in a game. The value was elsewhere.
So same core insight, same tech foundation, but completely different product and customer.
Precisely. They ditched the gaming idea, pivoted to offering a service helping people invest with professional managers using their evaluation tech, and now they're a major player. Learning drove the pivot.
Okay, so part 2, steer, is that whole engine. Build, measure, learn with actionable metrics, and make those tough pivot or persevere calls based on validated learning. But then how do you keep this up? How do you maintain speed as you grow? That brings us to part 3, accelerate.
Yeah, because the instinct might be, okay, we found something that works, now let's slow down, build big, be careful. But the sources argue that's often wrong. You need to maintain speed and agility.
And a key idea here is counterintuitive, the power of small batches.
Totally counterintuitive for many people. We think assembly lines, big batches, that's efficient.
Right, like stuffing envelopes. You're really doing all the folding first, then all the stuffing, then all the stamping is fastest.
That's what you'd think. But the analogy shows the opposite. If you take one envelope, fold the letter, stuff it, seal it, stamp it, complete the whole process for one, then move to the next, you actually finish the whole pile faster. Less handling overall. But the big reason is error detection. If the letters are too big for the envelopes or the stamps won't stick, you find out on envelope number 1. Not after you've folded 1,000 letters or stamped 1,000 envelopes incorrectly.
You minimize wasted work by finding problems instantly.
Exactly, which connects directly to manufacturing, like Toyota. They obsessed over reducing changeover time between different car models on the assembly line.
Why was that so important?
Because it allowed them to produce in much smaller batches. Small batches meant they could spot quality defects way faster. Think of their end-on cord system, where anyone could stop the line for a problem.
So faster feedback, fewer defects built up.
Right. Higher quality, more product variety, and ultimately faster production than competitors stuck producing huge batches of one thing, hoping it was right.
Okay, how does this small batch idea apply to building, say, software or a new service?
Same principle. Designing, building, testing, and shipping one small feature or change at a time minimizes the waste if that feature turns out to be wrong or customers don't like it. You learn quickly with minimal investment.
Instead of spending 6 months building a massive release only to find out it bombs.
Exactly. IMVU is the extreme example again here.
50 releases a day. How is that even possible?
Tiny batches. Small, focused teams working very closely, pushing changes live constantly with heavy automation for testing, acting like that, and hot cord to catch problems immediately.
And they had new engineers pushing code on day 1.
Yeah, partly to prove the system was robust enough to handle it. That speed is only possible because the batches that changes were incredibly small and the feedback loop was instant.
And this isn't just software anymore.
The sources say no. Hardware is getting faster to prototype 3D printing, better tools. Physical products are becoming more software infused. That example of SGW designing 8 complex physical products in a year, that's small batch thinking applied to hardware.
It's the direct opposite of that large batch death spiral.
Right. Where the releases get bigger and scarier, so you delay them, which makes them even bigger, introducing more bugs, more fear, paralysis. Small batches break that cycle.
The sources also revisit the 3 engines of growth: sticky, viral, paid, but now in the context of acceleration.
Yeah, once you've validated which engine is primarily driving your growth, you need to tune that specific engine to accelerate.
So if you're running on the sticky engine, high retention is key.
Absolutely. Your main focus in product development and marketing should be on improving retention, reducing churn, make the product stickier. IMVU's early days showed this. High user acquisition didn't matter because churn was equally high. Net growth was 0 until they fixed stickiness.
Okay. And the viral engine.
That's all about customers bringing in other customers.
Yeah.
So you obsess over the viral coefficient for every user you get. How many new users do they bring in?
That number needs to be greater than 1 for real growth.
For exponential growth, yes. Think of Hotmail adding that little PS, get your free email tagline. That was tuning the viral engine. Every email sent became an invitation.
Got it. And the paid engine.
That's growth fueled by advertising, sales teams, etc. You're buying attention. The critical thing here is the relationship between customer acquisition cost, CPA, what you spend to get a customer, and lifetime value, LTV, how much revenue that customer generates over time.
CPA has to be less than LTV, preferably much less.
Yes. The difference, that marginal profit per customer, is what you reinvest to buy more customers. That collaboration tool example, where they pivoted to enterprise but didn't fix their sales model, their CPA became way higher than their LTV for those new customers. Engine stalled.
So knowing your engine tells you where to focus your optimization efforts to speed up makes sense.
And to handle that speed and growth effectively, you need an adaptive organization, one that can adjust based on feedback and problems.
This is where the 5 whys technique comes into play.
Exactly. It's a simple but powerful tool for root cause analysis. Anytime something goes wrong, a server crashes, a key metric drops unexpectedly, a customer complains about the same thing repeatedly.
You ask why? 5 times.
Or until you really get to the fundamental underlying reason. You keep digging past the surface symptom. Why did the server crash? Because a process overloaded it. Why did the process overload it? Because it wasn't designed for that scale. Why wasn't it designed? And so on.
And the point isn't just to find the root cause, but to
Invest in fixing it, proportionally to the severity of the problem. If it's a minor glitch, maybe a small fix. If it's a major recurring issue, you invest more significantly in changing the process or system to prevent it from happening again.
So it forces you to invest in robustness and quality over time.
Yes. Even if it feels like slowing down in the short term to fix the root cause, it makes you faster and more reliable in the long run. It connects progress directly to learning and fixing systemic issues, not just pushing features.
The sources also talk quite a bit about applying these ideas inside established companies, which is often where innovation goes to die, right?
Yeah, traditional management structures, metrics, budgeting cycles, they can unintentionally crush new, uncertain ventures. Intuit's early struggles, Greg's experience mentioned in the source. Classic examples.
So large companies need a different approach, like managing a portfolio. Some safe bets, some disruptive ones.
Exactly. You can't manage a radical new idea the same way you manage optimizing your cash cow product. And one tool they discuss for enabling this is the innovation sandbox.
A sandbox, like a protected play area.
Kind of. It's a designated space, maybe metaphorical, maybe a specific team or division, where innovation teams are allowed to operate using lean startup principles.
So they can use MVPs, focus on validated learning, pivot, without getting immediately shut down by the standard corporate processes and short-term financial metrics.
That's the idea. Give them breathing room to experiment and learn, shielded from the pressures that would kill an uncertain venture too early. Kodak Gallery used small experiments to gradually shift culture. Another example started testing on just one pricing page before expanding.
It sounds crucial, but also probably hard to implement culturally.
Oh, definitely. The sources are clear. Shifting to validated learning often feels worse before it feels better. It's slower upfront, maybe messier. It requires changing deeply ingrained habits, especially around metrics and planning.
Yeah.
You need serious leadership buy-in.
And there's a warning, too, about product development pseudoscience.
Yeah, the danger of just paying lip service. Using data selectively to justify decisions you've already made, rather than genuinely using experiments to learn and potentially change your mind. Real validated learning has to show customer behavior changing because of your actions.
They even briefly float bigger ideas, like a long-term stock exchange, to reduce the quarterly pressures from public markets.
Right, acknowledging that some of these pressures hindering long-term innovation are systemic, way beyond just one company's internal processes.
Wow. Okay, that is a comprehensive framework. We've really covered the core arc here, how the lean startup offers this, well, disciplined, scientific-ish approach to dealing with that massive uncertainty and creating new things.
Yeah, the key takeaways are pretty clear. Entrepreneurship is management, but different. Validated learning, that's your real progress metric in the fog. Build, measure, learn is the cycle to drive that learning.
And then you have the tools. MVPs, built for learning, not just features. Innovation accounting with actionable, accessible, auditable metrics. Pivoting smartly based on data. The power of small batches for speed. Tuning your specific engine of growth. Using 5 whys for quality. And creating those sandboxes in bigger companies.
It's really a toolkit for adaptation, not a rigid formula, but a way to learn your way forward. It helps you channel all that energy and creativity in a way that's more likely to lead somewhere good.
It definitely makes you think differently about what making progress really means when you're in uncharted territory, and that focus on validated learning. It leaves us with a final thought for you listening.
If validated learning, proven learning about what works with customers, is the true measure of progress when things are uncertain, where might you, right now, be relying on vanity metrics? Things that look good but don't actually tell you if you're learning or moving towards a sustainable model.
And maybe more importantly, how could you shift that? What's one small change you could make to start measuring what really matters to accelerate your own validated learning?
Definitely something to chew on.